So the most consequential real estate stat of this quarter, it isn't coming out of Manhattan or Miami or San Francisco. It is actually coming straight out of Idaho, where the retail vacancy rate has just plummeted to a microscopic 1.0%. And if you're looking for like a massive power center or mall space, there is literally 0.0% available.
Yeah, zero.
Right.
Not a single square foot.
Literally nothing.
Right. It completely breaks the conventional models of, how a retail market is supposed to function.
Yeah.
We aren't talking about a tight market anymore. We're talking about absolute, uncompromising scarcity.
Welcome to the deep dive. Today we are tearing into the Q2 2026 retail market for Coeur d'Alene, Idaho. And strictly for the record, before we get any emails, we are pronouncing that Coeur d'Alene. After this, we'll just stick to CDA to keep things moving.
Yeah, good call on that. It's a classic mistake.
Right. So our mission today is to unpack the Q2 2026 market report provided by ACTIV8 Real Estate, that is ACTIV8 Real Estate, and really figure out how the local CDA retail dynamics have wildly diverged from the national narrative.
And it is a wild divergence.
It really is. I mean, we're talking 0% availability in major sectors, a bizarre disconnect in how these properties are being priced, and some recent outlier transactions that will honestly make your jaw hit the floor. And just to be clear, all figures we cite today are from this Q2 2026 market report. And as always, we promise to get you through this deep dive in under 20 minutes.
Yeah, and because we are dealing with conditions that are frankly unprecedented for this specific market, context is just everything here.
Yeah.
The raw numbers only tell half the story. The other half is what those numbers force buyers, sellers, and tenants to actually do in the real world.
Exactly. And just a quick note before we jump into the numbers. If you are trying to navigate the space and you need a custom market breakdown or you have questions about any of the data we cover today, you can reach out directly to Eric Peterson.
He's the guy to talk to.
Yeah, he's the designated broker at ACTIV8 Real Estate. You can call him directly at 509-903-9077. Again, that is 509-903-9077. All right, let's get into it. Ground us in the data. Give us the quarter in a minute. What are the headline numbers you need to hold in your head?
Okay, so looking at the trailing 12 months, the foundational story is just a severe supply and demand imbalance. Net absorption hit 48,000 square feet.
Which means?
That means tenants successfully leased and occupied 48,000 more square feet than they moved out of.
Okay, got it. And on the supply side, like the new builds?
Well, only 30,000 square feet of net delivered space actually came online. So demand fundamentally outpaced supply.
So tenants are eating up space almost twice as fast as construction crews can even build it.
Exactly. And that specific deficit is what pushed overall vacancy down 0.2% year over year to that microscopic 1.0% you mentioned in the open.
Wow.
Now, when we look at valuations, the estimated market pricing is sitting at $186 per square foot with a market cap rate of 7.8%.
Which I know we are going to dissect in a few minutes because on the surface, those pricing numbers actually contradict the whole scarcity thing.
Oh, highly counterintuitive, yeah. We'll definitely get into that. And finally, on the capital markets front, total sales volume over the last 12 months is exceptionally low. Only $14 million worth of retail real estate actually traded hands.
Okay, so if you're listening and you remember one single thing from this deep dive, it's that CDA retail is experiencing extreme scarcity, which is fundamentally altering how properties are valued and treated compared to the rest of the country.
Yeah, let's start with that scarcity because, 1.0% vacancy is an average, and averages can hide the most dramatic details.
Right, break that down for us because historically, CDA has been tight, but not this tight. And even if you look at nearby markets like Spokane, they aren't seeing this specific dynamic.
Correct. So the 5-year average for CDA retail vacancy is 1.4%. The 10-year average is 1.9%. So we are significantly below historical norms across Kootenai County. That's Kootne County.
Right.
But when you drill down into the subtypes, the picture gets really intense. Neighborhood centers are sitting at 1.7% vacancy. Strip centers are at 1.2%. General retail is down to 0.8%.
And then you have the heavyweight division, right? The big box stores.
Power centers and malls. Both are sitting at exactly 0.0% vacancy.
Literally zero.
Zero. Across the entire market, there is only about 180,000 square feet of available space. That translates to a total availability rate of just 1.5%.
I've honestly been thinking about this, like a massive high-stakes game of musical chairs, but instead of just one chair being taken away when the music stops, the music stopped and they took away all the chairs for the biggest players.
That's a great way to look at it.
So I have to ask, with power centers and malls at absolute zero, what does a major national retailer actually do if they want to expand into Coeur d'Alene? Do they just compromise on the type of building they rent?
Well, they either compromise or they just sit on the sidelines and wait. And this is where we have to talk about leverage. A 0% vacancy rate fundamentally shifts the power dynamic from the tenant to the landlord. It wipes out tenant leverage entirely.
Because they can't negotiate. They have no fallback option.
Exactly. You can't aggressively negotiate on your monthly rent or ask for the landlord to pay for your interior build-out, what we call tenant improvements, when the landlord knows there are 3 other national brands waiting in line right behind you. If you want into CDA, you have nowhere else to go.
So you take what you can get at the price the landlord dictates.
If you can get anything at all. Landlords have immense leverage right now. They can be incredibly selective. They can demand tenants with pristine credit, lock them into longer 10-year leases, and dictate strict use clauses.
Oh, wow.
Yeah, a major retailer might have to look at a neighborhood center and try to cobble together a smaller footprint than they originally wanted, just to establish a presence in the market.
Okay, but this begs a massive question. Normally, a 0% vacancy rate is like a giant bat signal for developers. It screams, hey, there's limitless demand here, come build. So why aren't we just building more chairs? Where are all the cranes?
It's the logical question, right? But you have to look at the macroeconomic headwinds fighting against developers right now. Building a commercial retail center takes immense capital, time, and, navigable zoning.
And right now, capital is definitely not cheap.
That's the primary hurdle. Commercial construction loans are tied to interest rates that are significantly higher than they were 3 or 4 years ago. Add in the inflated costs of raw materials and labor, and the actual cost to build a new retail center is staggering.
So the math just doesn't work out.
For a lot of developers, no, it doesn't. To justify the high cost of a new construction loan today, a developer would have to charge astronomical rents that even hungry national tenants might balk at. Plus, you have geographic and zoning constraints in a place like Coeur d'Alene. You can't just build a 100,000 square foot power center anywhere.
Right, which explains the 18,000 square foot deficit we talked about earlier. 48,000 square feet absorbed, but only 30,000 delivered. The market is basically drinking water faster than the pipe can refill the glass.
Precisely. And when that happens quarter after quarter, year after year, you inevitably grind your way down to a 1% vacancy rate.
All right, well, let's pivot for a second because this brings me to a piece of data in the report that I really want to push back on because it feels like a glaring contradiction.
You're talking about the pricing and cap rates.
Yes, the national disconnect on pricing. Because we just spent 10 minutes establishing that retail space in CDA is rarer than a unicorn. Basic economics like Econ 101 says that scarcity drives prices through the roof. When demand outpaces supply, values are supposed to soar.
Well, they are.
But according to the ACTIV8 report, the CDA market average pricing is $186 per square foot. According to CoStar data, the national average is $247 per square foot. So CDA is actually trading at a massive discount compared to the rest of the country.
It looks that way on paper, yeah.
And on top of that, it yields higher cap rates. CDA's market cap rate is 7.8% compared to the national average of 7.3%. If this market is so hot, why is it cheaper and yielding higher returns than the national average? It makes zero sense to me.
It's a brilliant observation, and honestly, it is the central paradox of this specific market. To understand it, we have to do 2 things. We have to break down the averages and then explain how cap rates actually function in commercial real estate. Let's start with the $186 average. You really have to look at what comprises that number.
Okay, unpack it for me.
Power centers, the ones with 0% vacancy, do hold a local premium. They're estimated at $218 per square foot. General retail is at $194. But then look at malls. Malls are estimated at $165 per square foot.
Even with 0% vacancy.
Yes, because the valuation model for a large mall in a tertiary market, like CDA, is fundamentally different than, say, prime street retail in a top-tier national market. Malls are massively capital-intensive to maintain. They have huge footprints, enormous roofs, and massive parking lots that need paving.
Right.
So they act as a heavy anchor, dragging the overall market average down to that $186 mark.
Okay, so it's partly an issue of composition. The malls are pulling the average down. But what about the cap rate? Help me understand why a 7.8% cap rate in CDA versus a 7.3% national average is a sign of lower valuations.
Let's do a quick refresher on cap rates, because it's arguably the most important metric in commercial real estate. A cap rate, or capitalization rate, is simply the NOI, or net operating income, of a property divided by its purchase price.
So it's basically your annual return on investment if you bought the building in all cash without a mortgage.
Exactly. If a building generates $100,000 a year in profit and you buy it for $1 million, that's a 10% cap rate.
Right. Straightforward enough.
But here is the inverse relationship that trips people up. A lower cap rate means a buyer paid a higher price for that exact same stream of income. If you accept a 5% cap rate, it means you paid $2 million for that same $100,000 of income. You paid a massive premium.
Oh, I see. So the fact that CDA has a 7.8% cap rate and the national average is 7.3% means buyers nationally are willing to accept lower returns. Why?
It comes down to risk and capital profiles. Heavy institutionalized national markets, like Los Angeles or Chicago, trade at lower cap rates because giant pension funds and institutional investors are willing to pay a massive premium for perceived safety, immense scale, and extreme liquidity.
They accept a 5% return because they're parking $1 billion and they just want it to be safe.
Precisely. But CDA is not driven by Wall Street institutional money. It is a tertiary market driven by private capital. And private buyers, high net worth individuals, and local syndicators demand a risk premium. They want that higher 7.8% return to justify the perceived risk of investing in a smaller geographic market that isn't as liquid.
That makes so much more sense. The scarcity is real, but the type of buyer dictates the yield. Main Street money demands better cash flow than Wall Street money.
You nailed it.
Which is a perfect transition, actually. Let's shift our focus from these theoretical market averages to how actual money is moving. Because when a market is this tight, it creates some truly fascinating outlier deals. Let's look at the transactions roundup.
This is where we see what happens when a highly motivated buyer enters a 1% vacancy market. They just have to pay up.
And we have a mega deal anomaly that proves this perfectly. Let's talk about 114 East Appleway Avenue.
This is the most significant recent sale in the report. It's located in the greater Coeur submarket. It's sold in December 2025 for $9.1 million.
$9.1 million, but it's the specific metrics on this deal that made my eyes bug out. The price per square foot was an astounding $1,900. $1,900 per square foot. Wait. In Idaho, you could buy prime retail space in Manhattan for that? What exactly is sitting on this lot that makes it worth that much?
It's all about the income stream and the lease structure. This was a 100% leased, triple net investment property.
Okay, for the listener who doesn't live and breathe commercial real estate every day, break down triple net, or NNN.
A triple net lease means the tenant pays practically everything. On top of their base rent and utilities, the tenant pays the property taxes, the building insurance, and all the maintenance. If the HVAC breaks, the tenant fixes it, not the landlord.
So it's basically the most passive form of real estate investment on earth. You just collect a check.
Exactly. I like to say you aren't really buying a building, you are buying a corporate bond that just happens to be wrapped in a building. And because it's so passive, buyers will pay a massive premium for it. That's why the cap rate on this deal was a highly compressed 5.4%.
Wow. Remember, we just established the market average cap rate is 7.8%. So this buyer, the report says Barry J. Powell, was willing to pay a massive premium to secure a safe 5.4% return.
Right. And there's a really interesting quirk about the seller, Scott Atkinson. The hold period on this property was unusually short, just 13 months.
What does a 13-month hold tell you?
It screams value-add execution. It tells me that Atkinson likely acquired the property when it had a vacancy or maybe an expiring lease, stabilized it by signing a high-credit tenant to a brand-new, long-term triple net lease, and then immediately flipped it to a buyer looking for safe passive yield.
Man, it's the ultimate proof of concept. It shows that even in a market dominated by private capital looking for near 8% yields, there's a subset of buyers who are absolutely willing to pay massive institutional-level premiums for the right stabilized, zero-headache asset. In a 1% vacancy market, a guaranteed cash-flowing property is practically priceless.
It is the ultimate flight to quality within a scarce environment. But, it's important to note this deal is an anomaly.
Right. How does that $9.1 million deal compare to the broader submarket activity?
It's a stark contrast. Post Falls actually saw the highest velocity of trades. There were 13 transactions there over the trailing 12 months.
But the total dollar volume was tiny, right?
Very tiny. Only $1.15 million across those 13 deals. So lots of small, granular movement. But the greater Coeur d'Alene submarket, where our Appleway anomaly sits, saw the highest total volume. $10 million traded there across just 8 deals.
Which means the Appleway deal accounted for over 90% of the volume in that entire submarket all by itself.
Precisely. It massively skews the data, but it perfectly highlights how rare large quality transactions have become in CDA.
Which brings us to our capital market snapshot. Because that lack of available space and these crazy outlier pricing models, they connect directly to the overall liquidity of the market. And right now, the ACTIV8 report describes a liquidity freeze.
It's a very apt description. Let's look at the raw numbers here. The total retail asset value in Coeur d'Alene is estimated at $2.2 billion.
That is a huge pie.
It's a very healthy market size. However, the 12-month sales volume is a meager $14 million.
I really want the listener to let that sink in. A $2.2 billion market, and only $14 million of it changed hands in an entire year? That is far less than 1% turnover.
Yeah, what this means for investors is incredibly clear. Nobody wants to sell.
Why would you? You've got golden handcuffs.
Exactly. When a market is performing this well, and vacancy is essentially non-existent, owners have incredible pricing power with their tenants. Rents are stable or growing, so owners are holding on to their cash-flowing assets. It leads to extremely low turnover and a severe lack of market liquidity.
So if you are a buyer with millions of dollars burning a hole in your pocket, it is incredibly difficult to find a willing seller unless you are willing to pay an absurd premium, like we saw on Appleway. So who are the buyers that are actually managing to find these rare deals?
Well, the data is definitive on this. The buyer pool is overwhelmingly dominated by private investors and owner users.
Owner users being like a local business that just buys the building they operate out of to control their own destiny?
Correct. Meanwhile, institutional capital and REITs real estate investment trusts are virtually non-existent here.
Why does private capital dominate this specific environment?
Because private capital operates with totally different motivations. They aren't just looking at DSCR, the debt service coverage ratio, for a massive loan. They might be utilizing 1031 exchanges to defer taxes on a previous sale.
Oh, let's pause there, because a 1031 exchange perfectly explains why someone might overpay. Explain a 1031 exchange like a shot clock in basketball.
I love that analogy. Okay, so in real estate, if you sell a property for a massive profit, the IRS wants a huge chunk of that in capital gains taxes. But Section 1031 of the tax code says if you take all that profit and roll it into a new property, you can defer those taxes.
But there's a catch.
A huge catch. The shot clock. Once you sell, you only have 45 days to identify a new property to buy and 180 days to close the deal. If the buzzer sounds and you haven't bought anything, you owe the massive tax bill.
Oh, wow. So if you are a private investor with a ticking shot clock and you are staring down a 1% vacancy market with a total liquidity freeze, you might be forced to accept a 5.4% cap rate on Appleway just to beat the buzzer.
Exactly. Tax deferral often forces buyers to accept lower yields than they normally would. It heavily distorts pricing in tight markets. Private capital is looking for long-term generational wealth buildup, tax shelters, and cash flow, not just quarter-over-quarter portfolio metrics like an institutional Wall Street fund.
It's Main Street money playing a totally different game than Wall Street. All right, well, as we start to land the plane here, let's look at the outlook. Where does the data project we're heading for the rest of 2026?
The forecast models suggest that this extreme tightness is just the new normal for the balance of the year. Vacancy is projected to remain completely flat and end 2026 exactly where it is right now at 1.0%.
So there is absolutely no relief in sight for tenants.
None. The supply pipeline, as we discussed with the construction costs, just isn't robust enough to change the dynamic in the short term. The leverage will remain firmly and uncompromisingly with the property owners.
It is a phenomenal time to be a landlord in CDA. But if you are a tenant trying to break in or an investor with a ticking 1031 shot clock trying to find a deal in a market with a total liquidity freeze, you absolutely cannot fly blind. You need an expert guide who actually knows where the off-market deals are hiding, which is exactly why you need to call Eric Peterson at 509-903-9077. Again, that is 509-903-9077. He is the designated broker at ACTIV8 Real Estate, that is ACTIV8 Real Estate, and he has the granular on-the-ground data to help you navigate this specific environment.
Yeah, when less than 1% of the market turns over in a year, public listings aren't going to save you. Having a broker deeply embedded in the community is the only way to play the game.
Absolutely. And that brings us to our final thought. We started by talking about a game of musical chairs where there are literally no chairs left for major retailers. Overall availability is a mere 1.5%, and power center vacancy is at absolute zero.
Yeah, absolute zero.
So here is the question we want you to ponder as we leave you today. At what point does this extreme, unbroken scarcity force a wave of creative destruction? Are we going to see old industrial sites or obsolete office buildings gutted and turned into massive adaptive reuse retail hubs? Or, and this is the scary thought for the local economy, will major national retailers simply look at the lack of space, shrug, and bypass Coeur d'Alene entirely, taking their jobs and tax revenue to other cities simply because there is nowhere left to put them?
It's the ultimate consequence of scarcity. When the music stops and there are absolutely no chairs, eventually people just stop coming to the party.
It's definitely something to keep a very close eye on. Thanks for diving deep with us today.